Hi everyone, thanks for joining us. I'm Jason Ferris, and I'm joined by our Chief Investment Officer, Jason Eliason. Now that the third quarter has ended, we thought it'd be beneficial to summarize what's transpired. There certainly seem to be a lot of noteworthy events over the last 3 months, Jason. What really stood out to you the most?
Yes, I agree. There were certainly a number of significant events these past 3 months. The Fed cut interest rates twice, which were the first interest rate cuts in the last 10 years. This is significant on many levels, but most notably, it really illustrates how active the Fed is trying to be in maintaining this economic expansion. Another major event was the S&P 500 index hitting an all-time high in July, before eventually losing some ground in August. Fortunately though, large cap stocks rallied in September, closing just about 1.5% off the all-time high. Another noteworthy event was the inversion of the yield curve. This received a lot of press because it has historically been an indicator of economic recession. The belief that this inversion is proof of a looming recession is misleading though. The length of time from the yield curve inversion to recession has varied greatly. Think about it, I think it was around 10 months in 1980 to 33 months in 1998. Another item is it really depends on how long the yield curve is inverted for. If it is briefly inverted, much like was the case this quarter, it would be considered more of an anomaly caused by forces other than a weakening economy.
So in our investment committees, we've been talking a little bit about being cautious.
Right.
Could you just elaborate on that a little bit?
Yes, certainly. That has been a topic of discussion for us this past quarter, and really a couple quarters before that as well. We're seeing signs that the US-China trade war, it's all in the headlines right now, plus the economic issues that are going on in Europe, if you really think about Brexit, they're really starting to impact the global economy. Our economy though, the US economy, is really tied to consumer spending. So long as you and me and everyone else is spending money, the US will be okay. But even there, we're starting to see some signs of softening. This is probably a good place to remind everybody that it's impossible to try to time markets. One of the items we noted in our quarterly write-up this time was that the S&P 500 index was up 243% the last decade. If you look at just the best 25 trading days, that's 1% of the total days, they produced 163% return. That means 1% of the trading days produced 2/3 of the return that we saw this past decade. That's amazing. Trying to time the market is futile. The key is maintaining exposure to the market. We allocate accounts based on 3 buckets of time. Risk, we talk about that a lot. We have a 0 to 2 year bucket, a 2 to 5 year bucket, and a 5+ year bucket. Money that is long-term, that's that 5+ year bucket. We need to maintain exposure to stocks there. When we're talking about being more cautious, it is really focusing on that 0 to 2 year bucket, that 0 to 2 year risk profile. It's essential that we discuss with clients their cash flow needs from the portfolio to make certain the proper amount of capital is allocated to that bucket.
Thank you, Jason.
Certainly.
And thank you for joining us. If you'd like to see a full report that Jason wrote up, it's found on our website, waller.com/blog. Thank you for joining us and have a great day.